Imagine a world where commercial ships are actively being attacked in the most vital energy choke point on the planet.
Right.
You've got a massive, indefinite military blockade looming. Geopolitical tensions are just at an absolute boiling point. And in response to all of this, global financial markets, well, they just hit record highs and take a nap.
Yeah, it's wild. It makes no sense on the
It's
surface.
a completely bizarre reality. But that is exactly the contradictory picture we are looking at this morning. Welcome to today's deep dive.
Glad to be here.
We are tearing into a pretty dense stack of sources today. Specifically, we're unpacking the 6 a.m. news brief from the Daily Tech Reader dated August 14th, 2026. And our mission for you today is simple. Reading the morning news right now can feel like drinking from a fire hose. So we are taking this chaotic barrage of global events and mapping out the hidden architecture underneath it. That way, you can walk into whatever room you need to be in today and actually understand the mechanisms driving all these headlines.
It's a fascinating day to look at the global board because the core theme jumping out of this briefing is a massive collision of realities.
How so?
Well, in the physical world, we're seeing escalating geopolitical friction, severe environmental breakdowns. But then in the digital and financial worlds, we're seeing booming markets and this level of infrastructure investment that just defies any historical comparison.
Right.
Trying to reconcile those two environments, that's where the real insight lives today.
Okay, so let's start with the physical friction, because I think we have to look at the bottleneck that everything else downstream relies on, which is the Strait of Hormuz.
Oh, absolutely. The ultimate choke point.
Exactly. The U.S. is currently preparing an indefinite naval blockade alongside what they're calling unprecedented economic measures against Iran. Defense Secretary Pete Hegseth stated the Navy is prepared to rotate ships and personnel to maintain this enforcement indefinitely.
Yeah, and Treasury Secretary Scott Bessent is actively pairing that military presence with total economic isolation.
And the diplomatic rhetoric surrounding this is, it's incredibly stark.
It really is.
President Trump points to this looming blockade as definitive proof that the United States fully controls the Strait of Hormuz. Meanwhile, Iran explicitly states that they alone control the waterway and will dictate which vessels may pass.
And just to pause here, as analysts, we need to be crystal clear. We aren't endorsing either of these viewpoints or validating anyone's claims of control.
Right. We're just relaying the geopolitical realities as outlined in the brief.
Exactly. Because regardless of who claims ultimate legal or military authority, this dispute is creating immense, tangible friction on the water.
Yeah, and we are already seeing that friction turn into physical confrontation. The United Arab Emirates just officially accused Iran's Revolutionary Guards of outright piracy following attacks on 2 ADNOC vessels in the Strait.
Wow. Were there casualties?
No injuries were reported, thankfully. But the immediate chilling effect on global trade is obvious. The brief notes that only 9 commodity vessels passed through Hormuz on Thursday.
Which is pretty low, right? Very low. It's down from the daily August average of 12.
So here is where my brain just stalls out on this. The Strait of Hormuz is essentially the world's highest stakes toll booth right now, where no one agrees on who collects the toll. Ships are being attacked, traffic is plummeting. So why did Brent crude oil only tick up to roughly $88.50 a barrel?
It's the great paradox of the day.
Right. Why isn't the global energy market in a state of sheer panic?
Well, think of the geopolitical risk right now as a tightly coiled spring. In a vacuum, the threat of an indefinite blockade and physical attacks on tankers, that should cause the spring to release, sending freight, insurance, and ultimately oil prices skyrocket.
Right, that's what you'd expect.
But right now, that coiled spring is submerged in freezing water. And that freezing water is incredibly weak global energy demand.
Wait, weak demand? But with all the AI data centers and global manufacturing running hot, how is the global appetite for oil actually shrinking?
It really comes down to the broader macroeconomic data. The International Energy Agency is projecting that global oil demand is actually going to contract throughout the rest of 2026.
Wow.
Yeah. And even OPEC, which usually paints a rosier picture for consumption, they just reduced their own demand growth forecast for the 4th consecutive month.
Okay, so the demand just isn't there.
Exactly. And if you look domestically, American crude inventories just recorded their largest weekly jump in more than 3 years. So we have this massive supply cushion. The geopolitical fire is absolutely burning in the Middle East, but the global economy is just too damp to let it spread into a major price shock right now.
Okay, that explains the oil prices. But I'm still trying to square this with Wall Street's reaction. Because looking at the broader economy, it feels like the stock market is just whistling past the graveyard here.
It really does.
Traders seem to be looking at this Middle Eastern tension and just completely ignoring it.
Yeah.
The S&P 500 closed at another record high, up roughly 14% for the year. The MSCI All-World Index is nearing a record. And the VIX, the volatility index that measures fear, is heading for its fourth consecutive weekly decline. Are investors just entirely ignoring cyber attacks and global tension because they're addicted to the idea of flat interest rates?
They're unbothered because Wall Street algorithms and institutional traders are laser-focused on a very specific domestic metric, which is borrowing costs.
All right.
The market is currently pricing in what we call a Goldilocks scenario. We're seeing very mild consumer and producer inflation data stateside. And because of that cooling inflation, traders are pricing in a 63% probability that the Federal Reserve is going to pause rate hikes in September.
Oh, I see.
Yeah, for a corporate sector that has been squeezed so hard by high capital costs, the prospect of stable or even lowering interest rates completely outweighs a foreign policy crisis.
But surely they can't just isolate the U.S. economy from the rest of the world. I mean, look at Japan. The yen is actually strengthening right now because there's speculation the Bank of Japan might actually raise rates in September. So if Japan raises rates while the U.S. pauses, doesn't that unravel a lot of the international carry trades that fund these massive market rallies?
It certainly introduces turbulence, which is exactly why that VIX number you mentioned earlier is so surprising. You've got tightening monetary policy in Japan and a potential pause in the U.S., which alters the flow of cheap capital.
Right, the money has to move differently.
Exactly. But the domestic market's confidence comes with a massive, fragile caveat. This entire stock market rally strictly depends on that geopolitical spring in the Middle East staying submerged.
Because if it pops.
If a major escalation occurs that actually chokes off physical supply, the lid on oil prices blows off. If oil goes to, say, $120 a barrel, inflation comes roaring back. The Fed has to hike rates again, and this whole Goldilocks narrative shatters overnight.
Which brings us to the sector that has everything to lose if borrowing costs go up, and that's technology.
Oh, yeah. Tech is in a weird spot right now.
Yeah, tech is dealing with an entirely unique crisis of its own right now, which is a crisis of expectations. The brief outlines that Applied Materials and Cisco both reported their earnings this week. They both beat revenue forecasts.
Yeah.
They both demonstrated strong demand, and yet their stock prices dropped. It's like, reporting record revenue but having your stock drop is like getting a 99% on a massive final exam and Wall Street grounding you because it wasn't 110%.
That is the perfect analogy. It is the brutal reality of the current AI cycle. The market has priced absolute perfection into these valuations.
Right.
When you have companies trading at these astronomical multiples, strong demand just isn't enough anymore. If a tech giant isn't completely shattering forward-looking guidance, improving exponential AI adoption, Wall Street treats a solid earnings beat as a massive disappointment.
I want to dig into the actual mechanics of this AI build-out because there's a headline here that completely shifts how we need to think about tech funding.
The NVIDIA news.
Yes. NVIDIA is partnering with major financial firms to mobilize up to $500 billion for AI infrastructure.
$500 billion.
$500 billion for data centers, cooling systems, networking equipment. But hold on. Companies like Microsoft, Apple, Alphabet, they have the highest cash reserves in corporate history. With NVIDIA needing $500 billion from private credit and banks, is the AI boom officially becoming too expensive for traditional tech companies to fund on their own?
It absolutely is. Because building an AI ecosystem has stopped being a software endeavor and has become a heavy infrastructure endeavor.
It's physically heavy.
Exactly. Training these massive foundational models requires data centers that consume as much electricity as small cities. You need real estate, massive water cooling systems, dedicated power substations. Wall Street banks and private credit firms are stepping in because an AI data center is no longer viewed like a traditional tech startup.
How is it viewed?
It is viewed like a toll road, a bridge, or a power plant.
Oh, wow. So they are essentially project financing the AI boom the way you would finance a hydroelectric dam.
Precisely. And this fundamentally shifts the risk, right? By bringing in banks and private credit, the success of the AI boom is now directly tied to global borrowing costs.
Ah, circling back to the interest rates.
Yes. If interest rates spike, servicing that $500 billion debt becomes a monumental drag on tech balance sheets. AI is no longer just a tech story. It's a finance story.
And we're already seeing the hardware numbers reflect this sheer scale. Foxconn reported that AI servers now make up 51% of their second quarter revenue.
Unbelievable.
CoreWeave is raising its capital spending plans again just to keep up with cloud computing demand. But this massive infrastructure vacuum is actively cannibalizing other sectors, right? Like, what does this mean for the person listening to this who just wants to buy a new laptop or a smartphone?
It means they are going to pay more. AI data centers devour high-performance memory components.
Right, because of the processing loads.
Yeah, specifically high-bandwidth memory chips. And because chip foundries are prioritizing those highly profitable AI components, there's a squeeze on the production of everyday NAND storage, the kind of memory in your phone or standard laptop.
Oh, I see.
Companies like SanDisk and Micron are seeing their stocks advance because memory prices are rising across the board. So as a consumer, you are directly competing with a $500 billion AI data center for the raw materials inside your everyday electronics.
All while these tech giants are trying to navigate a pretty fractured geopolitical map.
Yeah, that's the other layer to this.
Microsoft has closed at least 15 branches or joint ventures in China over the last 5 years. They debated a total exit in 2023, decided against it, but are now pivoting to a totally different strategy. They're finding growth by helping Chinese companies expand their operations internationally, effectively helping them navigate around domestic policy restrictions and U.S. export controls.
It's a highly pragmatic reallocation of resources. Microsoft is recognizing that dominating the domestic Chinese market might be politically impossible right now.
But acting as the digital Sherpa for Chinese corporations looking to operate in Europe or Latin America, that is incredibly lucrative. It really highlights how agile these corporations have to be. They aren't just writing code anymore. They are basically conducting foreign policy.
Let's follow that thread out of the data center and into the physical world. We're pouring hundreds of billions of dollars into these systems, and now we're deploying them onto our streets and into our skies. Pony.ai and Uber are preparing to deploy over 2,000 robotaxis across Europe, testing them against wildly diverse road systems and regulations. Ryanair is utilizing Google's Gemini and DeepMind models for crew scheduling and operational decisions. We are literally handing over the keys to physical logistics.
And in doing so, we are massively expanding our attack surface.
Yeah, that's the scary part.
Automation introduces incredible efficiency, but it also introduces severe vulnerability. The brief notes that OpenAI is currently evaluating its upcoming models to determine if they possess critical offensive cybersecurity capabilities.
Wait, really? Yeah, that they are actively trying to figure out if their own tools can be weaponized to break into the systems they're currently automating.
Which is a terrifying thought when you read the very next headline in the brief. A massive hacking group just claimed to have stolen data from Shell, Philips, GE, Pfizer, and dozens of other major organizations.
Foundational giants.
Exactly. These are massive industrial and financial pillars. My concern here is the sequencing. We have robotaxis navigating European streets and AI scheduling the flight crews for our vacations, but at the exact same time, legacy industrial giants are getting massively hacked. Are we rushing to automate the physical world before we've actually figured out how to secure the digital one?
We absolutely are, and that is the core tension of the modern tech landscape. The theme emerging from this data for Friday is execution under pressure.
Okay, unpack that.
We have skyrocketing demand for automation, colliding with unprecedented cyber risk and massive regulatory hurdles. If you're looking at your career right now, the durable advantage over the next decade isn't just knowing how to build an AI model or write code.
Right, because AI can write the code.
Exactly. The real career advantage is knowing how to deploy and manage these automated systems within complex, highly regulated physical environments that are being actively targeted by state-sponsored hackers. The bridge between the code and the concrete is where all the real value is.
The bridge between the code and the concrete. I love that. But it brings us to a pretty harsh reality. There are physical realities on this planet that we simply cannot code our way out of.
Very true.
While the cloud expands, humanity is still dealing with completely unhackable environmental and biological forces. Let's talk about the weather data in this brief, because July 2026 was just recorded as the hottest month ever for the contiguous United States.
Breaking records again.
Yeah, and we have strong El Niño conditions developing, and Tropical Storm Lala is currently bearing down on Hawaii.
And the impacts of Lala are severe. The Big Island is under a hurricane watch, with the potential for up to 20 inches of rain in isolated locations.
Wow, 20 inches.
That means catastrophic flooding and landslides. But the extreme conditions are totally decentralized right now. You have Saharan dust heavily degrading the air quality across Texas and the Gulf Coast. There's dangerous, entrenched heat across the plains and heavy rain creating flooding risks in the Midwest.
I noticed in the brief that technology is trying to catch up to this. China is actively applying artificial intelligence to regional weather forecasting to generate faster predictions.
Right.
But I have to imagine there's a limit to what a large language model can do when it comes to like atmospheric pressure and physics.
There's a massive limit. AI is incredible at pattern recognition, but it doesn't fundamentally understand physics. The brief rightly points out that scientists still have to rigorously verify these AI-generated weather forecasts against physical fluid dynamic models.
So they still need the old school science.
Absolutely. An AI might hallucinate a storm path based on historical data correlations, but the actual laws of thermodynamics still dictate where that hurricane lands. You just cannot replace physical modeling with pure statistics when human lives are on the line.
And the physical threats we're tracking aren't just in the sky. They're on our plates and in our communities. There is a multi-state cyclospora outbreak right now linked to contaminated lettuce, affecting at least 15 states and resulting in 2 deaths.
Yeah, that's incredibly concerning.
Furthermore, the U.S. is experiencing its highest annual measles total in decades, primarily concentrated among unvaccinated populations. So when you put all this together, whether it's preparing for extreme weather in Hawaii or just trying to navigate grocery shopping during a cyclospora outbreak, it feels like the physical world requires just as much daily threat assessment as the digital world.
It all comes back to a crisis of prediction and preparation.
How do you mean?
Well, whether it's the Federal Reserve attempting to forecast inflation, an AI model trying to predict a hurricane track, or the FDA tracing the supply chain of contaminated lettuce-improved prediction algorithms are entirely useless if the physical institutions fail to deliver clear warnings.
Right, if the message doesn't get out.
Exactly, and communities need the resilience to actually act on those warnings. Prediction is nothing without preparation.
And that lack of resilience is showing up in the cultural and economic data, too. The macro numbers tell us inflation is, quote-unquote, cooling, but inflation-adjusted wages are actually still lower than they were a year ago.
Yeah, people are feeling it.
That is putting a massive, sustained strain on discretionary income. People are having to make really hard choices about travel, dining out, and how many streaming services they can realistically afford.
And you can see how consumer behavior is adapting to that strain. People are consolidating their spending toward guaranteed shared experiences.
Like sports, right?
Exactly. Streaming platforms are spending billions on live sports just to keep subscribers from churning. We're seeing massive audience share growth in women's professional sports, and baseball's divisional races are driving huge engagement. When daily life feels expensive and unpredictable, people gravitate toward live, communal entertainment.
Which seamlessly overlaps with how our cultural institutions are operating. There's one final headline here that perfectly captures how deeply our political disputes overlap with our everyday culture.
The Kennedy Center story.
Yes. The Kennedy Center Board just voted to add an inscription bearing President Trump's name back to the building's exterior, following a previous federal judge's order to have it removed. And again, maintaining our neutrality here, we are looking at this purely as analysts. We aren't making any value judgment on the politics of the decision.
Right, we're just analyzing the event itself.
Exactly. But it serves as a stark reminder of how political authority and public spaces are in a constant state of negotiation right now.
You really can't separate them anymore. The geopolitical disputes in the Middle East dictate your gas prices. The AI investment boom dictates the cost of your electronics. Extreme weather dictates your supply chain. And political disputes shape the physical architecture of your cultural institutions. The whole global ecosystem is entirely interwoven.
We really covered the map today. We started by looking at military blockades in the Strait of Hormuz, unraveled the paradoxical calm of Wall Street, broke down NVIDIA's $500 billion pivot into hard infrastructure, and ended up tracking Hawaiian hurricanes and contaminated food supplies.
A very busy Thursday.
Very busy. But mapping those connections is exactly why we do this. And I want to thank you, the listener, for exploring how deeply intertwined all of these forces really are.
Yeah, and I want to leave you with one final thought to mull over today.
Lay it on us.
We spend a lot of time analyzing the hundreds of billions of dollars being poured into artificial intelligence, all with the explicit goal of making our digital systems faster, more efficient, and more autonomous. But when you step back and look at the physical friction, the vulnerability of our shipping lanes, the fragility of our power grids during extreme heat, and the basic safety of our food supply, you really have to ask yourself a question.
What's the question?
Over the next decade, will the most valuable technology in the world be the kind that allows us to move faster? Or will it be the kind that simply makes us more resilient when the physical world inevitably breaks?
Wow. That is exactly the question we need to be asking.
Thank
Thank you for joining us today and letting us help you map out the noise. Keep questioning the systems around you, stay curious, and we will catch you on the next deep dive.